Right. So continuing with this session, we're going to be looking at some style analysis now, 8.2, chapter 8.2 here, and the index model regression can be viewed as a way to measure and describe the way portfolio managers invest, right? So their style that they're adopting. And so effectively, and please read through the relevant sections in the FRM handbook, but depending on the returns of the portfolio that the asset manager generates, they can generate, and remember, there's many strategies that they can be following. So you may have a fund manager who wishes to use a medium cap stocks, right? They just believe that those are the ones that are very profitable. And you can regress the returns of the returns from the portfolio on the returns of the medium capitalization shares in the universe that are available for investments. The fund manager may believe that large cap is the driver, small capitalization shares. They may be using like a T-bill approach, high price to earnings growth, medium price to earning, low price to earning, etc. Right? There's many other styles. There are many styles that a fund manager may be using to generate returns. This is important, right? And for you to, well, as the risk manager, to determine what that is and to be able to, figure that out. And again, we were talking about asset, not so much asset allocation, but attribution, right? Where are these great returns from this given fund manager? Where are they coming from, right? Where are they originating from? Is it his or her medium PE approach or their low PE approach, right? What strategy are they implementing that is giving rise to these wonderful returns, right? Or poor returns. I mean, obviously you can attribute it to either. And you can do these regressions, as I say, the details are all in the FRM handbook, and you know what your regression coefficient gives you. That gives you your sensitivity to that particular approach. So this particular fund manager, well, it's Fidelity's Magellan Fund, not proprietary, it's long after the fact. And they ran this little regression, and you'll see it in table 8.4. And it turns out that most of their, well, 35%, if you want, it's not the way to interpret it, but the regression coefficient is 35 for medium cap approach and 61 for large cap. So they're clearly not focusing much on small cap approaches or the price to earnings ratios. They are selecting their stocks based on their capitalization, and that's maybe right, it may be wrong for you. You may have a pension fund, you may not agree with that, or whatever. There are many different types of fund. This is one particular fund, Fidelity's Magellan Fund. You can run a regression and you can determine the sensitivity of your fund returns to certain style twists, right? And you can get out the coefficient effects, extract the coefficients, and you can make important and interesting observations on that, right? We have spoken a little bit about market timing, that one of the sources of variations in portfolio risk is market timing, of course. So even though a stock price, a share price may be declining, over time, you may have this deteriorating share price. But remember, unless it's a really bad share, which is just going down monotonically, you can have the situation, and you often do, that a share will be, it'll decrease, and then there'll be a little bit of a bounce. Then they sometimes call it a dead cat bounce. You can read that up on the web. But a share price will sort of do this sort of thing. So it'll go down and jump up a little bit, but not as high as it was previously. And it'll jump down and jump down and jump down and up and so on and so forth. And I mean, you would have to be pretty skilled to be able to make good use of that, but it's perfectly possible. And if and assuming transaction costs are not too onerous, a fund manager can easily deal with this sort of situation. Well, not easily. Sorry, it's not. This is a non-trivial. Market time is quite difficult, and they can buy at the low and sell at the high, and then quickly get out of the position. Then the price falls again the next day. Buy there, sell when it goes up again. I'm not sure if one can do this on a daily basis. Maybe they can. Maybe we have machines nowadays that do it. But what I'm saying is, even in a declining market and a declining share price, you can make profits, right? And that's all about market timing. It's not so much your selection of the right stock, which should obviously be growing. That's what market selection is about, stock selection. But there's also, you can make profits from good timing. Maybe a terrible share, but it could be, if you've timed it right, you can still buy low and still sell high, right? And so in practice, where most managers don't shift between T-bills in the market, so there are ways you can account for these partial shifts in the market when it is expected to perform well. And a lot of the market timing, if you were just stock selecting, right, you were just choosing the right stocks at the right times and then holding them, right? You would just remember this graph that we're talking about here is pretty, you've seen it before, right? For this is basically your CAPM. So you've got a tiny little bit of alpha there. I don't know if they deliberately did this, but you've basically, over here, you've got your excess returns on the portfolio, right? Excess over and above the risk-free rate. So that's RP, return on the portfolio, minus RF, which is the risk-free rate. And on this axis, always on this, because the idea is that the excess returns on the market, so returns on the market minus the risk-free rate, are explaining these. So in other words, these returns are based off that. So you regress them on each other, right? And you might get a slope, and that slope is, of course, your beta. Remember your systematic risk, please go back and check that sort of thing. And so you've got your sensitivity to market moves measured by the slope, and the alpha is the excess return that you generate on your portfolio. If at all, it could be negative, it could be zero, but it's excess return that you generate on your portfolio when the excess returns on the market are zero. So when the market is not returning anything, you are still hopefully outperforming, and that little bit of outperformance is your alpha. Okay, so we know and love this. We've seen this many times. This is your straight capital asset pricing model, and that's the regression line that you get. But you can also get these other interesting features in B and C, right? So if there's no market timing, beta is just constant. You've bought the shares, and that's fine. There's nothing wrong with that. You've bought the shares and you've selected them on the basis of they've got high growth potential, or they've got high value, or whatever, right? They've got high PEs, whatever your style approach is. That's why you've bought them. But if you just buy and hold them and you don't mess around with timing, then you're going to get this sort of shape, right? If, however, there is market timing with all your shares, and you just, as things get better and better in the market, you increase your portfolio sensitivity is increased. That's what this means, right? So as we go, if returns in the market are low, your returns, your beta is not, that's not a very steep gradient, right? This is a much steeper gradient over here. Your slope is much steeper here than it is down here. So what this means is when market returns are low, your gearing, if it were your sensitivity to market changes, excess market returns, is quite low, right? It's still actually quite high in this figure, but it's lower than this. And as market returns get negative, as they become more and more negative, excess returns are negative, you could get higher returns on the risk-free rate than on the market. You reduce it even more. You can see how the slope is reducing. And as that reduces, as you get into more and more negative territory, more and more excess returns are negative territory. And that sort of makes sense, right? If you're really in a bear market and share prices are generally going down, you're getting negative excess returns, the portfolio manager will hopefully adapt to that. And, the sensitivity will be less. That's a good thing. That is a very good slope. Remember, this is a good situation. So is this. I'll come to that in a second. But let's think about this again. What this means, and the slope is 0.6. So that's great over here. That's great in the negative region, because what it means is when the excess return on the portfolio is negative, right? In other words, down here, anything to the left of the zero line over here. So this is where the excess returns on the market are negative, down here. And what that means is the excess returns on your portfolio are only going to be 0.6 times that. So you're not going to lose as much, right? The market loses 30% in a month. You're only going to lose 18% if all else is equal, right? If your alpha is zero and your slope is still, your sensitivity, which is your beta, is 0.6. 0.6 times 3, so 18%. So that's great. That's great for the downturn. That's wonderful, right? You have sort of protect yourself. You sort of slightly hedged there. But it's not so great on the upturn, because now on the positive side of that graph, right, to the right of that zero line over here. So over here, we've got positive excess returns, right? There the market is outperforming the risk-free rate. But there, this is not so great, because now the market, no matter how much the market goes up, you, because of your beta, if this is your portfolio, you're only generating 60% of those returns, right? The slope is 0.6. If alpha is 0, then these returns are equal to 0.6 times those returns. So if the market happens to surge by 10% in a month, that's great, but you're only going to get 6%, right? 10% times 0.6. Your portfolio is only going to return 6%, which is not so great. It's fine that you're protected from the downside, but over here, it's not so great, right? You're going to be penalized for that because you underperformed the benchmark. And your investors are going to say, but hang on, you know, the dumb benchmark, the market, whatever it is, you know, which is dumb in the sense that it's just like a whole lot of people doing their thing, right? And institutional investors and private investors and so on, buying and selling and supply and demand, but there's no real super overarching intelligence. Obviously, there's intelligence amongst the individuals components, but you know, there's no massive oversight doing this. Whereas you running an individual fund, you have got oversight, and yet you can't even outperform the market, right? So that's not so great. If the slope was about 1, it's also not so great, because then you are performing as the market does when it's positive, but you're also performing as badly as the market does when it's performing badly. So that's not, I mean, that is your traditional CAPM, but it's not the greatest situation. In graph B, the one on the bottom left, that's far better, because that's saying as the market returns increase, so your slope increases. Your slope over here, when the market return, excess market returns are high, right? We've got far away from 0. That's quite high. So this is saying the higher that excess return gets, you know, the higher your sensitivity gets, so the higher you're like leveraging your returns, right? And that's all about market timing. What to generate a excess return on the portfolio versus excess return on the market graph like that, the fund manager must be exercising market timing. They must be buying and selling at opportune times, buying here and selling there, to be able to produce that sort of curvature shape, right? And this is great. It's even better, because as you get into negative territory down here, your slope diminishes. So as things get worse and worse and worse in the market, you reduce and reduce. You can see as things are going further and further to the right, your riskiness, your sensitivity to those market changes diminishes. So far out, where the market, say, is returning minus 30% in a month, your slope has gotten almost flat, and you've got whatever, your sensitivity is only 0.1 now, you might only lose 3%. I mean, these are all hypothetical scenarios. I'm just saying the slope is clearly a function of how bad the market's doing, and it's moving in the right direction. As the market improves, as the market return improves, so your portfolio return gets more sensitive to it, so you tend to leverage up. And as the excess return on the market diminishes, gets worse, so you reduce your sensitivity to it, so you're not taking that many risks. And then, of course, panel C, which is this one here, that's the more common one. It's really quite difficult, and also because you have transaction charges for the B scenario, that's quite hard to generate, but it's more common. Well, it's not that common, but it is more common than panel B, is where you have 2 betas. So you have a beta for when the excess returns on the market are positive. So these over here, you have a sensitivity, and you have a different, when the returns on the market are negative, you reduce that sensitivity to the market returns to get that other slope. You can see the slopes are different. And focusing on the slopes at for market returns above 0, for positive returns now, for positive excess returns, you get that slope that's given there, and you can see that's good, because you've got quite a steep, you want a steep slope on this side, because as the market moves, these are all positive returns, so that'll be positive returns for you. So if there's a steep slope up here and the market returns quite a big change, if you see what I mean, they record a big change, a positive change, and you've got a steep slope, you are going to really leverage up your ratio, your returns. You're going to get very good returns when it's positive. And if you have this other, it's a different regime, right? Focused around 0, and you have negative excess returns, then the slope is slightly less steep. You can see that this is basically the discrete form of what's happening in panel B. So here, the slope is much lower slope. So here it might be, say, 1.2. So you are getting 1.2% of returns, excess returns, when the market is only returning 1% of excess returns, right? If the slope is 1.2. Let's say the slope here is 0.5. What that means is you've adjusted now. So you're saying, well, we're in a bear market. This is obviously a bull market where things are nice and positive and sometimes big and positive. But if we're in bear territory, so people are selling, the share prices are generally down, they're not doing very well, then your slope is, say, less than 1, say 0.5. Then what that would mean is here, where the market returns minus 5% in a month, minus 10%, I will only record half of that, right? If the slope is 0.5, I will only have a loss on my portfolio of minus 5%, which is great. I've outperformed the market by 5%. If they've lost 10 and I've only lost 5, I've outperformed the market by 5%. So this is a far more common situation than this one, but this is by far the most common. Regrettably, it's a little bit sad because it's fairly simple to do what's being done in panel C. Okay, so that's all about market timing. And as I say, that is definitely, you can only achieve these results in panel B and C using market timing, but so it's an important part of asset management. Okay, and then there's performance attribution procedures, how you attribute those returns to the different styles, to different asset classes, and so on. Please look, it's very simple, but it's an important sort of part of your education. Please look at what they do, how they approach it in the FRM handbook.